this is this company. So the speculoos, the small biscuit snacks, the company is called Lotus Bakeries. And I think that's from Belgium. Let me share my screen and let's start from the beginning. Please tell me when you can see my screen.
Yep.
Perfect. Okay. As we did last week, please don't hesitate to interrupt me, because I will just show you where to start, where to analyze the business, how to analyze the business, and sharing my screen. Maybe I won't see you in my screen, so don't hesitate. Interrupt me, ask questions. If you want me to go back in the analysis, I will go back and explain to you what is happening, and we can start. Okay. So we have the company is called Lotus Bakeries. Yep, Lotus Bakeries. We have this, and I mean, if you just check the price, if you don't find this investment enticing, look at this beautiful stock chart since 2000. If you had invested in 2000, you would have made a lot of money. That plus 15,000%. So when you encounter, for example, in a forum, or if you're curious and you want to know this kind of business, if you encounter this name, where do you start? I would advise for this beginner stage to type Lotus Bakeries investor presentation just here and see what the business is about. Because yes, we know that they create some snacks, some biscuits, but okay, I want to know the revenue, the financials, what is the competition, all of these things. So I would advise to just go on the website and you can scroll, you can navigate their website, everything you want. You can just browse and you go to the investor presentation page. You see, let's click on here, and the management will present some slides about what the business is about. Or it may take some time to load up the page because this is a small computer, but you have 37 slides of explanation of the business. Okay, what can you see? I have not read it. I've just checked what they look like, but I have not checked it. So I'm saying live with you. You see Lotus Bakeries revenue. Okay, this is just the financials for 2023. Okay. You see some track record, sustainable growth of, what's that? The revenue. Okay, really well. You see some snacks. You see the evolution. And okay, so we discover that Lotus Bakeries is not just with these biscuits. They sell other snacks, which is great. And this is a business that was established in the 30s. Okay, Belgium. Okay, Brussels. Very well. And they do several snacks. They do some acquisitions. Okay, just good. Just to have the goal of seeing these investor presentations is just to have a rough idea of what the business is about. Before we deep dive into the numbers, we want to know what they sell, how they work. Now we know that it's an established business from Belgium, and they have several snacks, and they do some acquisitions. Maybe they buy some competitors to have more snacks, but this is quite diversified. Okay, we continue. Lotus Biscoff. Oh, this is the Lotus Biscoff. This is what I have in my hand. So 50% of their revenue come from this Lotus Biscoff. Okay. They have grown a lot in 20% in 2023, and they have generated this biscuit, this snack, 16% growth of revenue from 2013 to 2023. So we can see that these small red snack generates some healthy growth in revenue. Okay, just have a sense of if this is growing or not. We also see that they have Lotus Natural Foods. I really don't know what that is about. Maybe that's, I don't know. Some growth, that's 1/4 of their revenue comes from the natural foods, and 20% come from another thing called the Lotus Local Heroes, and I have absolutely no clue what this is about. Okay, very well. What do we have? Geographical distribution. So the company sells not only in Belgium only 12%, but mostly internationally. So in the UK, US, France, yes, and in many countries. Okay, so this is a global business, not only specified to Belgium. Okay, let's continue. Just scroll and see what you can get. Have a sense of if you understand the business. Right now, for me, I mean, snacks, biscuits are not that complicated to understand. I could totally invest in a snack business. They just sell things that people eat. Okay, if I continue, that's global production footprint. So they have a factory over there, some factories over there, I suppose. Okay, natural food. Okay, accelerate growth of Lotus Natural Foods. What is that? I don't know. Let's scroll again for this natural food they sell globally. The Biscoff, the famous Biscoff. This is a good brand. This you see we have seen before 3 segments. First, the Biscoff, after that, the natural food, and the other stuff that was 20% of the revenue. So each segment has its growth. And for the Biscoff, the big brand, we see some great growth in revenue. So this is their main brand, and that's very good that they are growing. So if this Biscoff brand has grown for 14 years, at 16% per year, or like something like this, I suppose this is healthy, sustainable, and we can expect 10, 12, 15% of revenue in the long term. The past is generally a good indication of the future. Like nobody says this, but with an investing perspective, it's great to look at the past and forecast what the future will be. That's literally our job as investor. Okay, let's continue. Top 5 of the global cookie brand ranking. Okay, they show some competition. Oreo, Chips Ahoy. I don't know this one. What is that? Biscoff. Long term. I don't really understand what this slide is about. Growth is generated across the world. Yes. Okay, we've seen that the growth was global. Biscoff strategy. Okay, now that we explain their plan to continue growing like they've grown before in the past, from 2022 to 2032. Okay, what is their strategy? Bring the unique Biscoff taste experience to people favorite. Okay, growing market share at a healthy margins at every stage. What's that? Heroes, penetration. Okay, Halos, reinforce our brand. Nothing really specific. Demand spaces, no amplifiers. Okay, I don't find this really relevant. Strategic intent, activation levels, top priorities levels in e-stores. E-stores mean the company plans to sell this kind of stacks digitally. Range, distribution, visibility. I don't know, actually, that's not clear. Supporting levels. I want to know how they will continue to grow through marketing and media. So they will sell online, away from home experience, taste partnerships. I don't know. That's not clear for me. I'm doing the analysis like if I was alone, and for me that's not clear. I will not go deeper into this. We'll bring the unique taste, reinforce our brand, build penetration, growing demand, and doing some partnerships. Nothing really amazing.
Christophe, did you make like a sort of a mental note to say, okay, I'm going to go back to this later, or it's not clear for me that how they're going to continue growing? Because I was thinking the same thing as far as, okay, they've been growing really well, but are they going to reach a point where they've saturated the market they're in, and now there is risk of going, let's say, international? Maybe I don't know, the Canadian market will not like. Although I think they will be crazy not to like it. It looks really good, but you know what I mean. Like maybe they will have a hard time reaching to that market, and therefore there is a risk now that they can continue growing at the same rate.
Yeah, but for the moment, I don't find anything surprising. They literally say, we will continue to do what we have been doing for 4 years. Like more demand, more penetration of other markets. Okay, guys, no big news. We will enter new markets and do partnerships with brands. Okay, guys, no, literally nothing will change. So I'm just putting this in my head. No specific plan. They don't plan to buy Ferrero, Mars, or another big competitor about chocolate. They don't plan to go into different tastes. For example, they don't plan to go big into chocolate or fruits or nothing. Really, they say, okay, more range, more e-commerce, more brands, more partnerships, more penetration. Okay, so I'm putting this in my head. No big news, no big plan, because sometimes companies, they say in this presentation, we plan to do big acquisition that will generate X amount of revenue. So that's a question mark, because we never know how acquisitions will happen. Like this, like we see for this company, Lotus Bakeries, I see it like a safe bet. Like literally, they don't risk anything. They continue to do what has been working for years. So first impression is safe company. Belgium will continue to do what it's best at. That's the way I look at it.
Makes sense.
Okay, let's continue. Heroes. We will build penetration. Okay, several types of packaging. Yes, that's the innovation you wanted. Penetration of Biscoff Heroes, literally the same thing they've been doing. Digital, broad distribution. Yeah, in every store. Hellos, renovate, join. I don't really know. Social media. Okay. Okay. Individual moments. No, 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 no. Wow. Okay, okay, okay. Not relevant at all. Amplifiers. They will do partnerships with KitKat. Okay. They will do partnerships with agendas. Okay. Nothing, no big news actually. Financials. Oh, right now they will talk about their 2023 results. Okay, what can we see? Delivering strong results. That's the revenue 2021, 22, 23. Okay, so they are enjoying the COVID situation, continue to grow. EBITDA, I don't really look at it. Free cash flow, important, growing up and to the right. Okay, decent. We'll see later what the growth of free cash flow is, but just to have a sense of, okay, it's growing. Investments, I don't even know what investments are for this kind of company. The brand, the new factory in Mexico to build some Lotus Bakery. I don't know. Okay, net financial debt. Okay, they look at this, and the EBITDA will really not look at it. And dividend, small. Okay, small dividend. Okay, no big deal. Literally a company that is growing decently. 21% growth of revenue year over year from 2022 to 2023. Okay, I don't know why. For this kind of brand, I suppose you can increase your revenue by two means. One, by increasing the price of these biscuits. So the pricing is more price, more margins, or more volume. You sell to more people. But we will have to go deeper if you want to. Delivering strong results. Revenue growth, okay. That's in percentage, okay. Okay, they continued to grow in 2020. That's good. Revenue growth in euro. No, I don't care about this. REBITDA. I don't even know what REBITDA means. I know EBITDA, but with the R, I don't know. Strong top line growth. Okay, well, that's the same thing. Strong growth, sustainable growth. Nothing really surprising. Statement of profit or loss. We see that later. I don't usually look at this statement, income statement, cash flow statement in the presentations. I don't find it cool. I prefer to look at the real income of statement of income. That's the cost. Really, no big deal. No change. Nothing relevant over there. Evolution of net result. So profit. Profit again, up and to the right. Sustainable, healthy. That's the margin net result as percentage on revenue. 12, 12, 12, 12, 12. Literally a stable business with 12% margin. Okay. Investment program to support organic growth. That's the capex, so the investment. I suppose that's the plants, the factories that we've seen before in the slide, the global factories. Okay, that's it. Biscoff plant, Thailand, on track. Capex estimated in the range of 200 million euro for 2024 and 2025 combined. Okay. So for their capex, expansion and maintenance. Maintenance is the cost of running the factories to create the snack. So this cost is 10 million, 14, 19 million in gray. And the expansion is the new plants they build every year to grow more volume, to create more sales. So expansion capex is higher than maintenance capex. So they are investing in future factories, in better, bigger factories. And okay, they will have high capex in future years. We will see that later. Investments, okay. No, we are coming to the end of this investor presentation. Cash conversion, decent. Net financial debt, nothing. Really no big change over some months. That's since 2021. No big change. Strong balance sheet. We'll look at it later, actually. Oh, what do you see here? We are creating strong shareholder value. That's good. They think about us, the shareholders.
Yes.
Okay, the EPS growth, okay, we already know that it's about 10, 15% EPS growth. So that's good. We're good, decent growth of earnings per share and dividend growth up and to the right. That's when I recorded a huge masterclass on dividends and buybacks yesterday. So I think I will do the editing tonight and tomorrow, and I will continue, and you will have a new class of maybe 2 hours. That's a big video of buybacks and dividends. How to think about dividends, buybacks. Is this good or not? Because they can play a huge role on value creation for us shareholder. If the company is great at dividends, great at buybacks, it definitely makes a difference. So I would rather invest in the company that is good at allocating capital, thinking of us, the shareholders. So, okay, that's good news. Dividend growth, very well. Dividend as a percentage on the recurring net results. Oh, that's the percentage of net of profits that go to dividend. So 1/3 of their profit at the end of the year is paid to dividends. Okay, that's fine for me. And that's the end of the investor presentation. You see all the information we got out of 30 pages. Do you have some questions about it?
What's cash conversion?
Cash conversion is the amount of profit that is converted into free cash flow. Okay, let's see here. But well, okay, they start with a EBITDA. I don't really know what a EBITDA is, but normally you start from the net income, the first line. You do all your adjustments, payables, receivables, accounting terms, more inventories. You have your free cash flow, and you compare the net income, the profits, to the free cash flow. So you see, and this is a percentage. For example, right now we have 90% percentage. That means that the free cash flow is 90% of the net income. We have less free cash flow compared to the net income.
Oh, I see.
Okay, what can we go? Where can we go? Lotus Bakeries annual report. Let's see to have more information about it. Before we go deep dive into the numbers, I want to go to the annual report. Oh, because this is this small computer, I have to plug it. Because the battery will die. 2 minutes. I have it just here.
I'm looking at RIBITA online, and it's relevant period.
Relevant, okay.
I'm sorry?
No, I was just looking at the RIBITA, like the R, and it looks like it stands for relevant period.
Relevant, recurring, relevant. Okay.
It's weird.
What do they call relevant? Anyway. Annual report, let's see, English or NL. That's not from Netherlands, from Belgium. I don't know what NL stands for, but let's go for English. Okay, this is an annual report. Erica, did you already see some annual reports, or this is your first time?
Well, I was looking at the Monster one because I was watching that portion of the video for evaluating Monster, but so I would probably say no. This would be my first real one.
Okay, perfect. Oh, in the annual report, so that's annual, at the end of the fiscal year, the company tells you everything about what happened during this year. So every company it's mandatory. They are forced to publish the annual report, and you will get all the financials. So you can customize your annual report the way you want. For them, they have some nice slides. They talk about their mission. You have a message from the CEO. Very well. I mean, you will not get a lot of value out of this because they will tell you only the good news. Christophe, they can tell you what happened, what were the big things happening in 2023. Like Biscoff, how they operated 2023. For example, in all the annual reports in 2020, they had, before the annual report begins, the message from the CEO talking about the COVID, that's sad news for the world. They have the private message to deliver to the world. So this kind of customization. And you start with this summary of what is inside the annual report. I want to go to the business section of the annual report. So normally, that's the chronological highlights of 2023. Again, okay, they talk about their business. Our strategy. Okay, the first segment of the annual report, that's the private message, personalized message. The second part of the annual report is they explain what the business is about. They are forced to do it. What we see here is that the business presents 3 strategic pillars that we already know because we saw the investor presentation. 50% of their business is this biscuit, this red biscuit. Okay, that's the growth in 2023 that we already know growing well. Is historic CAGR, compounded annual growth rate. Okay, so they've been growing 16% for 10 years. And strategic ambition, build Lotus Biscoff to the cookie number 3 in the world. Okay, I don't know who is the number 1 and number 2, but anyway, they have this Lotus Natural Food, 24% of revenue, and local heroes that I don't know what it is about, but 22%. Okay, very well. We can scroll down. Our mission to be superior, branded. Yeah, they want quality. They want to be omnipresent, and create joyful moments. That's the goal of a brand about snacks. So that's normal. What do you see here? They talk about Biscoff, 50% revenue. So we learn nothing over there. And that's minuscule. That's really small. They talk about their brand, the first pillar of our strategy. I don't know if you can see well because it's really small, fine print.
Yeah, it's good.
It's good? Okay.
Yeah.
Okay, they talk about their strategy. The globalization of Lotus Biscoff is the first pillar of our strategy. Biscoff has a highly universal loved flavor. Okay, everybody loves Biscoff, appreciated. Okay, our ambition is high. We want Biscoff to become the number 3 cookie in the world. Our mission is to deliver in 60 countries. In the last few years, we achieved strong growth. Okay, internationally, okay, nothing really amazing. So half of the business is Biscoff, and half of the business is growing well over the past 10 years. Strong growth and international growth. Okay, that's the ranking in the cookie sphere. Growth model updated and strategy exercise. You have a small comment over there. New Biscoff growth model. Okay, let's see. What do they have to say about their big segment? In early 2023, they conducted another strategy exercise, collaboration with another company. Okay, nothing great. Legitimate ambition to have a fair share. Literally, they continue to do what they're good at. They want to sell to more countries and have better product. No big news really. New Biscoff growth model. We want the Biscoff cookie to be number 3. They don't say anything new. Okay, let's scroll down. Let's continue. The halo effect.
It's a little bit interesting that the CEO and the CMO are the same person. It looks like a very marketing-driven company.
Yeah, CMO stands for Chief Marketing Officer.
Yeah.
That's the same person.
Same person, looks like it.
Of Natural Foods. Natural Foods is the blue segment. No, yes, that's this one. So the CAO is the CMO for this. Okay. I don't know if that's big or not, actually. Anyway,
it means like they're really focused on marketing, like that.
Oh yeah,
that's what it tells me.
That's good for snacks. That's good for snacks.
Yeah, because there's no innovation beyond just how do you position the product. Yeah,
it's really literally zero innovation for this kind of industry. They sell snacks, it's the same snack, and in 10 years it will be the same snack. Internalization strategy, they will continue to invest internationally. We've seen this graph that wasn't helpful. They will continue. price and promo, distribution. Yeah, you want them to be available at Costco, visibility, range, marketing, away from home experience, and partnerships, revenue growth. Okay, we already knew that. We already knew that. A new look for Biscoff. Okay, that's a new look. Okay, very well. Ambition. Okay, what do we have? Literally, the business is very simple. So for Biscoff, they will continue no innovation at all. Biscoff, strong brand, and they want to continue to be a strong brand. For natural foods, okay. Oh, that's way more diversified. 24% of revenue, historical CAGR of 17% for the past 10 years. So similar growth to Biscoff. The goal is to accelerate growth through internalization, innovation, acquisition. Okay, if I zoom in over there, what they have to say? Internalization. Okay, okay. They just want to accelerate international growth. Okay, okay. 33% of revenue in these brands is generated outside the home market. Home market is Belgium for them. Okay. Okay, nothing new. They just sell different kind of snacks. Let's scroll down. Let's continue. Expand its production footprint. Yeah, they sell internationally. Let's scroll down. Let's scroll down. I want to see the other segment. What is that? What? Ah, that's the ads. Lotus local heroes. Okay, that's the interesting, and that's some new slides we didn't have before. Okay, local heroes, the third segment of the company that represents 22% of revenue, has seen no growth for the past 10 years. 3% growth, so literally that's the bad child of the family. 15% growth in 2023, strategic ambition, secure market leadership, and strong cash flow. Okay, they don't precise if this is with growth or not. Okay, so people buy less of this compared to the two other segments. The local heroes are the third strategic pillar. This includes a wide range of local brands and products, waffles, cakes. Okay, that's different kind of biscuits, snacks, but they sell less of this, and this is not growing at all. 3% is not a lot of growth. So they can sell whatever they want. They will have strategies anyway, no growth. They can say whatever they want. 3% growth is okay. This is the third segment that is not growing at all. Still, it can generate stable revenue, which is cool. Stable profits, stable cash flow. That's fine. But okay, this is not the same kind of growth. Okay, tasty, healthy. Okay. Okay, they talk about sustainability and other stuff. And I think that's it for the annual report. The goal of looking at the annual report was just to double check the segments of the company. Like we did for Google last week. Okay, what are the segments of the company? What are the growth rates, the priorities of the companies? So for the two first segments of Lotus, Biscoff, and the other one, that I forgot the name of, growth. They grow 16%. And no big shift in strategy. They will continue to sell internationally, more brands, more stores, no big change. For the third segment, no growth, stable revenue, but okay. That's what I can see from the annual report. Right now, let's see the financials of the company. Let's start on GuruFocus to just have a sense of if the company has grown its overall revenue, net profit. On GuruFocus, you can have a snapshot of the company's financials, the fundamentals. Okay, Lotus Bakeries. Oh. No, Lotus Bakeries. Okay, let's see what we have. The stock price is a mess because that's from Belgium. Let's see, because that's a decent sized company. They are available, listed on several stock exchanges. You can trade them in the Belgium stock exchange, but also in the US, UK, and German. So let's just click on the US here. And normally, oh, what is, if I change, I want the correct stock price. Let's see. Okay, up and to the right. That's the stock price I like. What do we have? Let's scroll down. On GuruFocus, you have, as I said, a snapshot of the company. You have a small description that I never read, to be honest, but this is just a small summary of the business. They produce snacks, various range of brands. Okay, they sell internationally. I suppose they will tell us exactly what we've seen before. The first thing to look when I go to GuruFocus is generally the financials. That's the main point of using GuruFocus. You want to see strong growth in revenue, strong growth in earnings, and that's what we see right now. We see the revenue going up, net income going up, okay, and we see some decent return on invested capital, okay. But let's first start with the top of the screen. We have our gross margins at 40%, operating at 16%. For the moment, the goal of, I suppose that's for you, George, the goal of looking at these numbers is just to have a rough idea of if the business is profitable or not. Because if you have a gross margin of 40% or 8%, that's a different game. Don't worry about all the colors. They just compare it to the industry, to history, but that doesn't impact much our analysis. Just to have a sense of gross margin 40%, okay, operating margin 16%, which is quite profitable for this kind of business. Net margin, as we've seen, 12%, as we've seen the profit margin in the investor presentation. Free cash flow margin, a bit less, but I don't look at this. ROE, 20%, 20%. Okay, the returns are decent. We saw in the investor presentation that the business was growing 15% per year, something, the revenue, something like this. And we see some return on invested capital at 14, 15%. So decent, not exceptional, decent. Okay, let's continue. The PE ratio for the business is, wow, 62. So definitely overvalued. The forward PE ratio, so for the earnings of next year, are a bit lower, but still we have a PE ratio of 60-50. Right now, if you don't want to waste more time, you could dismiss the investment case right now, at this moment. George, you asked me when to dismiss an investment case. You could do all the analysis you want, but if you want to buy only at a cheap price, there are other businesses with 15% growth that are cheaper. So the business is now overvalued. Currently, free cash flow, price to free cash flow of 90. Okay, we'll go deeper into these numbers to see what they mean. But what I see right now is, yes, strong growth, decent returns, decent margins, but overvalued. Okay,
would you put it then at your watch list and say, you know what, it's a good business, maybe analyze it a little bit more to make sure it is a strong business, and then watch for it when it goes down to say, okay, you know what, now it's an attractive price and now I could buy it.
Yeah, you could do that. But
okay,
my strategy is to, even if it's overpriced, I usually do the analysis. In case it drops for some reason, I will be ready. If we have a COVID 2.0 and it drops 50%, so the price to the PE ratio goes from 50 to 25, or I will be ready at this moment. But if you're just browsing the stocks, if you just want to scroll opportunities to see new investment opportunities, you can just dismiss the investment case and go elsewhere. It's just that my personal style is to go deeper and have a better sense of the investment case.
And
yes,
when you're looking at that PE ratio, would you also look at the average PE ratio for the industry that this stock is in? Because how do you determine what's a high PE ratio for a company?
Generally, on an absolute basis, a PE ratio above 30 means overvalued, means expensive. So on an absolute basis, everything above 30 is expensive. So on this basis, it could be 40, 50, 60, that's expensive. After this, you can compare, yes, to the industry, but we can see that later, or you can have other websites. I've never checked the GuruFocus stat to compare the industry. What do we have? P ratio worst. What is the average for the industry? Median is 18, I suppose.
Oh, I see. Okay.
Oh, and you have versus history. The median was 30 for this Lotus Bakeries, this business, this Belgian business. We don't have the average. We have the median. Okay.
Yeah.
We will see on Stock Unlock how to have the average. So don't worry. But okay.
Okay.
For the industry, okay, that's way overvalued. About the charts.
Sorry, kind of still on the P ratio. Like, would you pay a little bit more if the growth is there? Like, would you say, okay, you know, this business deserves a bit of a higher P ratio because I'm seeing high revenue growth?
Yes.
Okay.
Yes. If a business is growing 50% per year, so it's superior to the other businesses, I will pay a higher price. They don't deserve an average PE ratio. They don't deserve to be, they are not an average business, so they don't deserve an average PE ratio. You have to pay up for quality.
Right.
And how would you quantify that? Like, how would you say, okay, you know what, this is growing 50%, but this other company is growing 40%. So how would you kind of like normalize these numbers into something that, I guess I'm looking for a formula.
There is no formula. If a business is growing 14% or 16%, it has no importance. Literally, we are speaking about two digital numbers, no importance. But if a business grows 10% per year and the other one grows 30% per year, yes, at this time there is a big difference, and I would not pay a PE of 15, but you can maybe pay up to a PE of 25. Either way, I would not pay a PE of more than 30. On an absolute basis, that's what I advise and that's what I do. The PE over 30, I'm not interested. So the range between fairly valued at a PE of 15 and a bit overpriced is between 15, PE of 15 and PE of 30. That's the range. And you can, if you have a maximum high quality business, yes, you can pay a PE of 28. That's the way I look at it.
Okay.
Yeah, that's why for you, Monster is still too expensive.
Yes, because this absolute rule of a P of 30 helped me a lot avoid mistakes, and I will continue to do it. That's still overvalued.
Yeah, because you always have a good feeling, say, oh, it's decreasing more than 10% in 1 month. It's a good moment, but when you are watching the P ratio, you say, yeah, it's still too expensive. Too high.
Yeah. When you look at the big picture of a business and you compare to the industry, yeah, that's a bit expensive. What's the P ratio for Monster? 40, 50?
30 right now, 31.
31.
91.
Oh, slightly expensive. So slightly, not that expensive, but still not in my range. Still not in my range.
I understand.
Okay, what do we see on GuruFocus? We see this small liquidity ratio. You have seen in the course the current ratio to see if the company is healthy financially in the short term, which is more than 1. So they have more cash in the short term than debt in the short term. So if anything happens in the short term, they can weather the negative event. Okay. We just scroll down, buyback and dividends. Okay, you see, and we already knew that they paid a dividend. It's a small dividend. We are talking about a dividend yield of 1%, less than 1%. Okay, the payout ratio is the percentage of profit that goes into dividends, but we've seen in the investor presentation that they paid 1/3 of their profits. 1/3 is paid to dividends, so that makes sense, about 30%. Let's continue. Okay, for the first graph, what do we see? In blue, we have the revenue. Here, we can click here, to only see the revenue. It was 2012, in 2012, 300 million and 1 billion right now in 10 years. So a triple in 10 years. Okay, decent. Let's look at the net income. I just want to see sustainable growth over there. So I don't want choppiness. I want things to go up and to the right. Because in the investment presentation, they said that they were sustainable, growing, safe business, 16% per year. I want to verify this. I want to see in the numbers in 10 years, this happened. Did we have great sustainable growth over 10 years? So revenue, that's the case. Check. Net income, check. Check again. We go from, let's say, $25 million of profit at the end of the year to 125. So that's a 5x. You see more growth than revenue. Revenue was a 3x. Net income is a 5x. Okay, so I suppose they became more profitable. So you can expect more margins, whether it's gross margins or operating margins. They have become more profitable in 10 years because the profits have grown more than the revenue. And for the EBITDA, I never look at it. That's that's the curse word. For the cash position and the debt position, it takes into account the short-term debt and long-term debt, so everything. What we see is that the cash was nothing or minimal cash, 10, 20, and then it goes up to 131. And you will see the debt growing. Oh, wow, they have a lot of debt. 300 million of debt. Okay. What is the market cap of this? What is the market cap? That's $8 billion. So they have $8 billion and they have 300 million of cash. Oh, that's nothing. If you want a percentage, let's put here on the phone. I have 300 divided by 8,000. That's 3.7% of their market cap is in debt. No big deal. Actually, no big deal. And no big deal. And
So
we will
for you,
see
it's
later.
not a big debt.
No. You see on the graph that could be terrifying because the debt is growing in the red because that's compared to the cash, but I compare in percentage. The cash, for example, it's 131 million of cash divided by 8,000 to the market cap. So 1.6% of Lotus Bakeries is seated in cash. Is sat in cash. So they literally don't have cash, and the debt is 4%. So that's okay. I would be afraid if
for you it's nothing.
20% of their market cap is in debt. 15%, 20%. Wow, that's a big deal. And you will see just later, we see this graph here. That's the cash flow. So operating cash flow, free cash flow, net income, cash flow for dividends. Okay, that's a lot of things. Let's remove SBC. Let's remove cash flow for dividend. That's the dividend you see negative line in purple. That is paid to dividend every year. Paid. Okay, so let's remove it. Let's look. That's the net income. The same net income that we've seen just above here. That's the same one. Up and to the right. Let's see the free cash flow. Ooh, we see some interesting stuff. And operating cash flow. What do we see? We have a mismatch over there. What do we see? We start from our net income up and to the right. It was a 5x in 10 years. Okay. What about operating cash flow? Operating cash flow up and to the right. We see some things over there. So I put in my head, okay, what happened in 2016? What happened? This computer is slow, but I would go to text edit and put, okay, 2016, what happened? I want to know, maybe they did an acquisition. Maybe they sold one of their operations. Maybe, I don't know. But something happened in 2016 that generated a lot of cash. Because you see the growth in net income was smooth. No, there was an up trajectory, some increase in net income, but not a big spike like we see in operating cash flow. So something happened over there. And we can compare it to the free cash flow. And free cash flow is a mess. Okay, what to look here? We start from negative. And then in 2016, again, we have our big spike. We don't know what happened. And then back down. Okay, 2018 down again. 2020 up. And then 2022 negative, up again. Okay. I suspect, because we've seen some development of factories, plants, the capex that we've seen in the investor presentation. You remember the maintenance capex and the growth capex? They want to build more factories. And this
one
has
in Thailand, right? Like on track, they're saying. So that could be
Yeah, they put the Thailand the factory on track. I don't. Oh, I'm not in the page anymore. But we saw some graphs about capital expenditures. You remember the formula for the free cash flow? To get the free cash flow, so the cash at the end of the year, you take the operating cash flow and you remove the capex. You remove all the costs associated with the new factories in Thailand that we create some biscuits, some snacks. So I suppose in 2022 they invested a lot in new factories. Okay, so I put in my text edit. You can put 2022. What happened? You want to go to the annual report of 2022. Okay, we can do it right now actually, and see what happened in 2022 because revenue went up, net income went up, profit went up, everything is doing well, and the free cash flow negative. What happened over there? So actually, we can do it right now. If I put free cash flow, I want to see the cash flow statement. Actually, you know how it works now. You've seen the class on free cash flow. So okay, financial statements, page 200. Oh, that's 2 pages though. So it's at 100 pages, something like this. Okay, consolidated financial position. Okay, I think that's total assets. That's cash flow. No, that's the balance sheet. I want to see some cash flow. Revenue, net assets, comprehensive income. That's the balance sheet. I don't know.
So this is about looking at the track record.
Yes, we want to check the 10-year history of the business. If we see strong growth, strong fundamental, because the past is a great indicator in the future. And actually, Lotus Bakeries, it turns out it's a great business. But for some businesses on GuruFocus, you see some declines. And for me, if I see some decline in revenue for the past 10 years, decline in net income for the past 10 years, it's a pass. I go and check another business. That's a red flag. Okay, let's not invest in decaying businesses. Okay, that's the income statement. That's the balance sheet. And I'm afraid I can't see the cash flow statement, which is strange. Maybe the Belgium regulation doesn't force them to have a cash flow statement over there. So if we want to see what happened in 2022 regarding the free cash flow, we can do it via stock unlock. And if on stock unlock, you can check the performance, the financials for the balance sheet, income statement, cash flow statement for the past 10 years, 20 years. So Lotus Bakeries. Let's see. Come on, small computer. It's slowly dying. Wow. I have to change it. Okay, let's go on financials. By the way, Stock Unlock improved. Before, it was a great website, and now it's even better. So I highly encourage you to use it. Why? Because right now you have this tab called KPI data. If I click on it really quick, instead of going to FinChat, you can actually go and check the KPIs of this business. So they said that they sold snacks in different countries, but exactly what is the revenue in UK? You have it. Exactly what is the revenue in Belgium? You have it. Okay, I suppose you have to pay a higher price to get the past performance for the past 10 years. I have 5 years over there. That's new. That's only a few weeks old. France revenue. Seems like I'm the only one that increased the sales. Netherlands revenue, other geographic, UK segment, recurring, elimination from segment. You have plenty of KPIs. I don't know. Okay, that's countries. Capital expenditures. Ooh. Oh, wow. You have. Okay, so they invested in UK. Something that we didn't see in the annual report, actually. Capital Belgium capex. It's improved. I don't know what they did after COVID, but they created a lot of factories. Capital expenditures. Okay. It's not quite telling, but it's great to have a geographical breakdown. But that's not why we went to see Stock Unlock. We want to see the cash flow. We want to see what happened in 2022 that created this loss. Loss in free cash flow. I suppose that's the capex. Okay, this is Stock Unlock. In this we have a lot of numbers. We want to go to the line here, cash from investing activities. Okay, that's it. And we want to see, okay. Erica, are you lost right now, or do you want to explain what is happening?
No, I'm following. It's good.
Okay, that's good. We have the cash flow. So you start from the net income and you remove the cost, you adjust, you get the cash flow from operating activities, something that we've seen on GuruFocus. That's this one, up and to the right. By the way, big spike in 2016. So we can actually see, what was the number for 2016? 118. And on this 2016 to 16 here, 118. It's over there. What changed? The net income was there. D&A is added back. We have this change in net working capital. That's it. You see in past years, negative, 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 positive, negative, negative, negative. Okay, what happened here? A change in net working capital. Net working capital is the change in operations. For example, the change in inventories in the short term, change in payables. When you pay your suppliers, you don't pay them now, but you pay them in 3 months. So you pay in credit, and some customers pay you in credit. For example, Costco asked to buy, 3 million of this, and Costco said, I will not pay you now, I pay you in 3 months. Okay, fine. So you don't receive the cash yet. That's the short-term cash fluctuations. That's the change in working capital. So not a big deal. Actually, that's the part of being a business. This is a moving entity. You get some cash in, some cash out. Some years the change in net working capital is positive, negative, but what we see is not alarming at all. So obviously, instead of being a minus, that's a plus. So the operating cash flow will be huge compared to other years. Okay, so now we have explained why this big operating cash flow. Okay, we have seen that this is not because they sold some operations. This is not because they changed their strategy. It's just the part of the business. They collected the cash. Costco said that they will pay you in 3 months, but well, they pay me in 3 months. This is the part of being a business. I'm talking about 3 months, but it could be 1 year, 2 years, this kind of stuff. And that could be strange because it's negative, 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 positive, but that's not alarming at all. Okay, let's continue. We have the cash from operating activities, investment in property, plant, and equipment. So that's the new facilities. That's the thing. Okay, negative, negative. Obviously, that's a cost. And you see in 2022, some big plans happening over there. You go from 40 to 120. And then it decreases in 2023. But still, 2022 was a year of investments from the company. So if you want to know what happened in 2022, I advise to go directly to the annual report. That's it, 2022, Control F, capital expenditure. Okay, let's zoom in. I don't know for you guys, but it's really small for me. Expenditure, what was the number for 123? What is capital expenditure? Why is that 150? I don't know. Total investments 150, including both capital expenditures. Oh, the acquisition, they did an acquisition of 100% of the shares of Peter's Yard and the investment of corporate venture. Okay. Maintenance capex at this. Okay. Oh, that's good. They mentioned that the maintenance capex remains stable year over year. So they have some factories and the cost of operating these factories have not increased. This is just some growth capital expenditures. So the big minus that we've seen here is the new capex, but I want to see how they spent it. The capex for 2023 are estimated to be, no, that's 2023. Actually, no, I want to know how they What were the costs for what? Did they build a new factory in Thailand for good productivity available factories? What did they call that? Investments. Local investments. Okay. In 2022, we invested in no less than 4 continents. We built additional production facilities. In Belgium, the US, we announced our plans to start up a production facility in Thailand. We already knew that. To further support the growth for ambition, okay, Asia Pacific. Okay, let's continue. Okay. I want numbers actually.
Yeah.
Okay. Okay. Why can't I see numbers? That's the benefit of investing in US companies. For the US, you would have already found everything because the auditing is different. The official annual reports are in the same format. For Europe, every country is different. So, for example, we don't have the cash flow statement. That's strange. But yeah, that's Belgium, I suppose. Investments. No important projects and investments. Faster. In 2022, we have invested a record amount in capacity expansion. Okay, that was our guess. So that's real. Mainly for Lotus Biscoff, our red snack, limiting the net impact of shortages, building materials, machine parts, and technical components on the delivery. Planned investments allowed the new capacity to come into operations. Okay, so they build more factories that will be in line in production with the 2023. So they build some things in Belgium, and we see no amount. We don't see the costs of the new factories in Belgium. Same thing for the US. They don't precise. They can avoid to precise the cost. They cannot mention the cost at all. So the more factories in Belgium, in the US, in Thailand, okay. Oh, okay. Actually, they don't want to mention the costs. Okay, that's not a big deal, but because we know that's factories, they have not done something big about, I don't know, ice creams. Okay, no, I don't see. Total investments amounted to 150, but in the 150, they include an acquisition. They did a small acquisition, so the real number is 123, as we know, and the rest would be other investing activities. So the sum of this should be more elevated. That's 140. Numbers that don't add up. Okay. Capacity expansion projects reaching 12 months high of 120. So we have our capex number here. New factories at 120 million, but we don't have a precise number. Okay, I think we will move on. What do we see? Plant, property, and equipment, assets. No. By the way, you can see the increase in capex in the new factories in the balance sheet. This is the balance sheet. We have 2021, the property, plant, and equipment, it was 300 million. And in next year, we have more property, plant, equipment. So 120 million more property, plant, equipment. That confirms that they didn't do anything stupid with the cash. It's just, you can trust them when they say, we build more factories. Yes, I see that you've built more factories, because if it didn't match up, if you had not seen this kind of increase, it would be a yellow flag actually. But right now, no red flag. Okay, let's continue. I've spent too much time on the free cash flow. You might find this boring, but that's some due diligence.
No,
Okay.
it's good, because that, for me, that's always has been one of the biggest challenges, is that I look at those numbers, but then I have no idea where to go from there, where to find, where to validate. Validating information is important for me. Yeah.
Oh, perfect. So now you
Yeah.
know how to do it. Annual report, Control F, and
Yeah.
Control F. And if you don't find information in the annual report, in the investor presentations, you can look at articles, external research from some people on the internet that wrote articles about it. For example, I don't know, you can go to I have this in this tab, Value Investors Club. Maybe somebody has written an in-depth research article about Lotus Bakeries. Lotus, no, nobody. So you can go to Lotus Bakeries Seeking Alpha. I don't know if you have to pay to see this. I suppose it's free for 2 articles per month or something like this. But you type the name of the company, Seeking Alpha, which is the name of the website, and you will see. Oh, it's loading. That's so slow. You will see some articles written by individuals. That's not professionals. That's right. I have to mention it. That's not professionals. That's not amateurs, but beginners, investors, retail investors that have written something about it. So that's from 2017, 19, and for this year, 2 articles. So if you wanted to see some things in 2022, actually you don't have any article from 2022. So that's a bad luck. And that's a Belgium company. So nobody writes about a Belgium company. But yeah, if you can have some Substacks or other external research about it. But anyway, we have our response, so we don't have to check other articles. We know what happened in 2016, so working capital positive, and we know what happened in 2022, big investments. And I suppose that's the same thing for 2018. We could do the same thing for 2018, do the research, but I want to move on. Okay, and before we talked about the debt of 300 million. Okay, that's significant or not? No, that's 4%. And you know what?
I have a question about that. Sorry, why is it compared to the market cap? Like, why are you looking at the market cap percentage rather than available cash or assets that they can sell to pay the debt?
I just want to know if this is a big part of the company. I just want to know if this will be a big issue. I compare it to market cap. So we see that this was 4% of the company. And I compare it to the free cash flow or operating cash flow, but or net income. What are the profits that the company makes? We've seen net income, you see in green, 130 million. Free cash flow is similar, 90 million, and operating cash flow a bit more, but we have overall 100 million of profits at the end of the year, of cash generated at the end of the year. Okay, that means in 3 years, they can pay all their debt. We compare 100 million of cash flow at the end of the year compared to 300 million of debt. So that means in 3 years, they can pay all their debt. That's fine. And that's very safe. You see sometimes company, they will need 12 years to pay their debt. So wow, if there is an issue, that's a big issue. 12 years is a lot. 3 years, that's not a lot at all. That's very safe. And
that makes more sense to me, like using the net income or the cash, because like the market cap, the reason it doesn't make sense to me as much is it feels like, well, how can you translate the market cap into, what would you do with it to be able to pay the debt, unless you start like diluting shareholders, and at that point maybe the share price will drop. That's why it was a little strange to me to. But I see it as a quick analysis, but I just don't know if it does. Like, can they say, you know what I mean? Like,
yep, absolutely. Just for me to have a sense of, is it a big burden or not? But if you had to look at one thing, yes, that's what we see, the free cash flow, net income, and compare the free cash flow. Let's go for the free cash flow. Compare the free cash flow to the total net debt. So we compare 90 million to 300 million. Okay, in 3 years, they can pay everything. And actually, it's less than 3 years because they already have 100 million of cash. So in 2 years, they can pay down all their debt. So you can play with some numbers, some quarterly numbers to see things happening, but nothing is changing. That's a stable business. Let's go back to the annual rate. And in this graph, next graph, you see the return on invested capital and the WACC, so the cost of running operations. Don't spend too much time on it, actually. Just nothing is surprising here. We have a return on invested capital of 10, 11%, 10, 12, 14, 13. Exactly what we've seen in the investor presentation. No surprise at all. You see this line in black that is return on invested capital minus the WACC, the weighing average cost of capital. So that's the cost of running operations. So some people say that that's the value creation of the business, because you take what the business generates minus what it has to pay, the cost, and so revenue minus cost, you get the profits. So on average, 10%, 10, 14%, 10%, 10%. This is not extremely good 30%. This is not 35%. We are talking about 10%. So that's a safe European business, like many European businesses. If we scroll down, we see the buybacks. Nothing to see here. We see in red, that's buybacks. In green, that's share issuance. Okay, you see 3% more shares in 2012. Nothing, that's nothing. And a 4% buyback in 2013. Actually, that's not significant at all. We are talking about 1% buybacks. Nothing to see here. This is not a yellow. It's not a red flag. This is not a green flag. Really, nothing to see. There were maybe some acquisitions over there. Some things happened, but it would be a red flag if you see green candles year over year of 3%, 3%, 3%, because that means that the share outstanding would increase over time. This is not the case. We have 700 million shares, and right now we have 800 million shares. Nothing significant at all. And this, I never look at it. That's the equity total assets. I don't really mind. Okay. By the way, if you scroll down, you have the graphs. You have this big graph. If you are a visual person, I don't often look at it, but that's sometimes great. Okay, so actually we've learned a lot about the company. The strategy is quite simple. The financials are okay. Not a lot of growth. Almost no debt. Almost no cash. Decent return on invested capital. Okay, let's continue. I want to go a little bit deeper, and I will go to stock unlock. You see stock unlock, you go to the general tab, you will have all these big interface, market cap, food products. I think you have some additional information about the company over there, the description to make sure you have understood the business. You have some competitors here. Okay, but that's not what we do today. I like to go into insights to see the score, the stock unlock score. Good, okay, but I mostly want to see the very bad insight score. What could be red flags for the company? Average, average, good, good, good. I want to see what is red. What is red? Bad. Intangibles as a percentage of assets. Okay, that could be bad. 30% of the assets are intangibles. For you will see, you will develop this kind of thinking when you analyze many companies. Intangibles are the patents, the goodwill. Goodwill is when you buy a competitor and the surplus of the price. For example, if you buy a competitor that is worth $10 billion, but you pay a premium for this, you pay 15. Well, you do 15 minus 10, you have additional surplus of 5 million that you have to pay up. That's goodwill. That's part of the intangibles. In the intangibles, you have the patents, trademarks. So for a brand company like Lotus Bakeries, like Coca-Cola, the brand, all the patents they have, this is intangibles. So I'm not worried about this high intangibles percentage. 30%, I mean, that's not significant. I want to see the very bad signs. Very bad is the average analyst rating that we can totally dismiss, because there is not there are not a lot of analysts analyzing this, and I don't really look at what analysts are saying about the company. Payout ratio 150%. I suppose that that's just a 1-year event. We've seen before that dividends increased up and to the right over 20 years. We've seen a payout ratio of 30%, 30%, 30%. So just don't look at it. That's insignificant. And free cash flow payout ratio, this is exactly the same thing. The dividends as a percentage of earnings and free cash flow. And now and now we are talking about the high valuation. P ratio of 62 compared to the 5-year average of 45. So okay, price to free cash flow 90, price to sales very high. Okay, that's expensive. You have all the red flags that we've seen before are confirmed here. Okay, let's go to financials now. Let's have some fun. And actually, I want to show you a simple way of doing the analysis is to directly go to freeform. Freeform, we will look at financials over the past 20 years. Okay. Now we want to start from the beginning. Let's see the revenue over 20 years. Because on GuruFocus, we've seen since 2012, I think. So 10 years, 12 years, 12 years. But on Stock Unlock, we can go deeper. So GuruFocus was our first filter. Good, bad, okay, some questions, annual report, okay, why is this happening? Some questions that are raised. Okay, that was the first filter. Lotus Bakeries passed this filter, despite the valuation. Okay, but we have the valuation. That could be something bad. We have a medium growth, I would say, but still it's a great company. But now we want to see on a longer time scale. So since 2004 or 20 years, we've seen some great growth up and to the right. That's quarterly. We see during the great financial crisis, the revenue has been stable, which is great. There are few companies that were stable during the great financial crisis. Okay. And on GuruFocus, I love it. You have the CAGR, the compounded annual growth rate. So you can say with confidence that over 20 years, the revenue has grown 11%, which is great. Despite the great financial crisis, despite the COVID, we see no crash. We see no decrease. That means that the company is resilient to any economic shock. We've had the worst financial crisis since 1929, and still the company is generating profit, revenue and profit. We've had the biggest pandemic for decades, still the company is growing. So that's very, very good news. And if we compare this, let's go down to the gross profit. We see that, oh, no, I want to see the gross margin, sorry. Gross margin, you understand that we are going down to the income statement. We start from the revenue and we go down gross margin, gross profit, operating margin, net income, EPS. What we see for gross margins, we see that they were at 16%. And then I don't know why. I really don't know why. In 2008, they shoot up to 40%. Again, if I had texted it, I would say what happened in 2007 to 2008. Same thing. You go back to the annual report, check what happened. Maybe they merged with another company that was more profitable. Something happened there. And I don't know. If I want to compare to see the EBIT margin now, this is not the same trend. We see some improvement in 2008. Oh no, I don't want the EBIT. I want the EBIT margin. Did the same mistake. EBIT margin. We see some improvement, but not as significant as the gross profit. So I really don't know what could happen, what could have happened. But we have EBIT margin of 12%. 12%, and we have some better margins right now. So the EBIT margins, the operating margins, that's the marketing cost, the employees cost, the R&D, research and development costs. So all these costs are part of the EBIT margin. That's what makes the margin. So we have 12, 12, 12, 13, 12, 14, 12, 11. And then for some reason, 2013, I don't know what, you can put in your text edit 2014. What happened that boosted profitability, but profitability improved in 2014. Okay, we go from 13% margin to 16. That's 3%, but still good. And we have a plateau over there, 15. So that confirms what we had seen before on GuruFocus. We saw that the revenue in 10 years did 3x. We go from 300 to 1 billion. So you multiply by 3. And net income, you multiply by 5. 25 to 105. I said, okay, I suppose the company was more profitable. It's becoming more and more profitable. We have the proof. We confirm what we guessed before. And this was the change. Something changed. I don't know. Maybe they doubled the price of these snacks. Maybe they entered the new market. Maybe the international markets that they want to improve right now. Maybe when you sell abroad, this is more profitable. Maybe the sales are in Mexico are more profitable. I don't know. Maybe they entered the US at this time, and in the US people love snacks. So maybe it's more profitable. Again, annual report. Check what is happening over there. Okay, that's the EBIT margin, and I want to check the net income. Obviously, it will be up and to the right. We already have a sense of net income because we've seen it on GuruFocus. This up and to the right, but I want to see over 20 years, not 10 years, but 20 years. 20 years, so nothing. 2000. Okay, struggling. Okay, and now boom, and even during 2008, the company did not change at all. The company improved, was more profitable during the great financial crisis. So this is a really resilient company. So when I tell you expect the future to be like the past, I mean it, because they have survived many things in a great way. They are in shape. They have survived 2008 in shape. Mm-hmm. So you can expect them, if we have a major issue in 2030, you can expect them to survive because they've done it twice. So that's amazing. Up and to the right, even in COVID, we see COVID 2020 here. No bulging at all, no change at all, and more profitable. And the compounded annual growth rate for net income was 14%. So we've seen before the revenue was 11%. And we see the CAGR of net income is better. It's normal. It's because the margins are going up. So over time, it's more profitable. So profits are growing more than revenue. And well, I think we can see the EPS, and I suppose the EPS will be like net income, because as we've seen on GuruFocus, we've not seen buybacks or share issuance. We told that this was quite stable, so I don't expect a lot of change over there. We have a CAGR of 14%. Okay, exactly the same. Okay, so no big change over there. And if we remove net income and revenue, we see EPS up and to the right. Again, that's some unbelievably strong, resilient business that we have here. What about free cash flow? We've seen some changes in free cash flow, so we expect some. We expect this. Okay. The chart doesn't start in 2004. I don't know why, but that's the way Stock and Lock works sometimes. If I put this, does it change? No, I don't know why. But okay, we have some cash flow generation. And I suppose that every time the free cash flow decreased, it was because of heavy investments in international factories, something like this. I suppose that's the case. So you could tell free cash flow is maybe not the best way to value the business. We've seen before a PE ratio of 60, price to free cash flow of 90. We saw that on GuruFocus a bit before. PE ratio 60, price to free cash flow 90. So you can say, oh, wow, the price to free cash flow is really expensive. But in that case, because of choppiness in the free cash flow, personally, I would not use price to free cash flow for this business. And because I know plenty of other valuation tools, plenty of valuation ratios, I could be flexible. And I know that, okay, revenue is stable, so I can use price to sales if I want. Earnings, quite stable. So the PE ratio could totally work. Price to free cash flow, no. No, I would not use price to free cash flow as a means for valuation. You have the CAGR, okay, which is a decent 13%. But you see the choppiness. That would mean that if you are in 2022 with a negative free cash flow, that means you have a price to free cash flow, which is negative. Even if this is really tiny like this, like free cash flow of less than $1 million in 2019, you would have a price to free cash flow of 500. Actually, we can see it. Price to free cash flow. Price to free cash flow on cost. Nope, I won't. I've seen it. Price to free cash flow. Okay, let's see. Very well. You have the price to free. Wow, you have the price to free cash flow of 1,000 in 2010. Okay, let's have more recent data. We have a price to free cash flow of 15, 15, 20, 30, 0 because of zero negative free cash flow, I suppose. 50, 50. You see this choppiness? You go from 40, 25, and then again 100 price to free cash flow, and then back to 40, and then 100, and then you go to 300, and now you're okay. So choppy. This choppiness doesn't prove anything. If you compare this choppiness to the price earnings ratio, because earnings are more resilient, stable, sustainable, using this, you can have a better sense of valuation. You see? So if you compare the two metrics, that's two different games. The P ratio, okay, what can you see? The P ratio for 2005 was 10. Okay. And then the great financial crisis occurs. You go from 16 to 11. Okay. And you see this big drop. I suppose for the P ratio, you have two things: the P, the price, and the E, the earnings. We've seen before that earnings have not bulged, earnings have not decreased. So if we have a change in PE ratio, that means the stock price dropped here. So actually here could have been a wonderful opportunity to buy. If you have stock price adjusted, I suppose we have a crash in 2008. Oh, that's an iceberg we have. I don't know. Lotus Bakeries stock. You see, this kind of arbitrage opportunities are great because you know that, okay, earnings are solid, resilient, but still the stock price has dropped. So this will be tiny. You know what? Let's go over there. If you want to see some graphs of stock prices, I recommend to go to investing.com. That's the website I use. You have the app. I use it daily, and I've used it daily for 10 years now. So it's the best. It takes a lot of resources of your computer. So my computer is slowly dying, but it's working really well if you have a decent computer. Okay, you can go to the chart actually and check in 2008. Okay, I want to see full page. Full page. Here, remove here. I want here, and I want to scroll back to 2008. That's the stock price. Very well. Stock price, you can see that's each candle is on a daily basis. Now each candle is on the weekly basis. And what do you see? Strong growth, obviously, but you also see this in 2008, 2009. Okay, that was our change. Stock unlock. I want to see the PE ratio. Price earnings ratio. Okay, it was in 2007 over there. Okay, not significant at all. And then the price stayed low because the stock price major stayed crash. Low. Okay. Very well. Use some small decline, 15% decline, I would say, but no big change over there. Okay, let's continue then. We have our price to free cash flow that went from 10 to 25 to plateauing in 25, 30, 25, 30. And then since 2020, wow, as a safe haven, you have a P ratio of 60, 50. So the overvaluation is quite recent, actually. Here, you could have bought the business at the P of 26, 25. Here, 27, 28, which is decent. You have a great resilient business with a strong brand that will be here for 20 years. So you can pay a PE ratio of 25. If you want to play it safe, it's okay to pay up for this business because it's a very high quality business. It would not be shameful to pay 25 PE ratio of 25 for this business. It's just that since 2020, boom, the stock price, the P ratio just shot up.
I'm curious,
Okay.
you mentioned for your first choice is price to free cash flow. If that's choppy, like we've seen, it doesn't turn you off because it's not a problem in the business. You know that the business needs to do frequent investment for future growth.
Yes.
So you understand that. So that's okay with you. Then you say, okay, you know what? I want to evaluate. So I'm going to use other ratios. And the next one will be price to earning. And if for whatever reason price to earning is also choppy, you would use price to sales.
No, this would stop the analysis.
Okay. So price
because
to earning has to be positive.
Yeah, earnings has to be smooth up and to the right. If on GuruFocus we had the choppiness over there, even if it's still going up and to the right, if we see choppiness, that means it's a cyclical company, and I don't like cyclical company, and I would not advise at your stage to invest in cyclical companies. I mean, you have 50,000 stocks publicly traded, so you have the choice between 50,000 opportunities. Why would you bother looking at choppiness if you can have the smooth ride? I mean, you have the choice. Go for the easiest path. So the easiest path, the easiest journey is to invest in smooth businesses that compounded slowly but surely. That's the best way of playing it safe and making money.
Yeah.
So yeah, if there is some choppiness over there, I'm not a fan at all. At all. So yeah, the P ratio. I want some indication. I actually don't look often at the price to sales. Price to sales, price to book. I don't like them. They are decent, but PE ratio, price to free cash flow. Because at the end of the year, that's what matters. The sales doesn't indicate much profitability. You can have, I don't know, I don't even know what the price to sales for this business is. Price to sales. Okay, going up, but I don't know. Price to sales of 1, and now we have price to sales of 6. I don't even know how to interpret this compared to industry. If that's good, I don't know. I don't know what, and it doesn't indicate much of the profitability compared to the PE ratio. You can literally have a means of knowing the profitability thanks to the PE ratio because it's earnings after margins after all the costs. Also, something that I like to watch for the past 20 years is obviously the return on invested capital. What can we see for the ROIC? 20% coming out of the great financial crisis, 20%, 20%, 15, 30, okay, back to 17. Oh, okay. It's not 0%, by the way. The chart starts at 12, so don't be biased by this. It's going down to 12, back up to 16, 16, and now it's at 14. Okay, that's exactly what we suspected. A slow business, decent growing business, growing 10, 14% per year, and they have return on capital of 10 to 15% per year. So if you want to play it safe, that's what you want to see. That's great. Actually, that's choppy, a little bit choppy, but it's between 10 and 15. Nothing significant. That's between 10 and 18. So that's decent. That's what you can expect to get in the stock market out of this investment. So that's good. If you buy it at a good price, that's what if you buy it at a P of, let's say, 20, 25, that's what you can expect to get. 14% per year, which is better than the Dow Jones, which is better than the S&P 500, which is better than our French CAC 40, obviously. That's very decent. what can we see in the on second look? Oh, they have added also some KPIs. Instead of looking at the main metrics, we can actually go deep into the fundamentals, cash flow statement, and look at the accounts payable for this business. Okay. I don't know if this will be useful for you. I've never done this. And account receivable, accumulated, current ratio. We've seen that debt was not an issue. Long-term debt. Long-term is going back up. Net debt. I think we will just continue to the valuation part, and that will be the end. Net debt. Okay, the net debt, the debt has never been a problem. The history of the company shows that net debt is superior to zero. That means they have more debt than cash. But that's okay. We are talking in a few millions, 200 millions, 100 millions, literally not a big deal. I'm just seeing some graph here, some metrics. No, that's the goodwill. Oh, by the way, the goodwill was quite high. They mentioned that intangibles was a big part of the assets, and they have goodwill over there. If I had to texted it, I would say, look at goodwill. Look at what is present. I want to know in the annual report, the intangible assets. What are inside these intangible assets? You see on the balance sheet, on the asset, intangible assets and goodwill. Okay, they are separated. That's good. 200, 150. That's 350, which is almost the equivalent of the plant, property, and equipment. So I would just type on Control F intangible assets and see what is inside the intangible assets. Maybe they will mention it.
What are you looking for exactly? So if it's a high number, what does that tell you?
They mean that they may own some patents, some trademarks, but I want to know what is this, just to have a better sense of what is inside the intangible assets.
But there's no red flag there. It is what it is, kind of thing. Okay.
No. The goodwill has to go up over time because they do some acquisitions, just out of curiosity, because I don't know about this brand, Lotus Bakeries. I didn't know that they had a lot of patents. That's out of curiosity. That's additional, but that's not part of your main analysis. I would advise to not spend time if you don't want. That's it. So what are the takeaways from this analysis? And after this, we will go to the valuation. We have seen some great numbers, sustainable growth, decent growth, 10, 15%. Margins, stable. Gross margins have increased in 2008. I don't know why, but since then, stable. Operating margins slightly increased. So the business has become more and more profitable over the past 20 years. Revenue going up despite all the crises. So resilient, strong business. Margins stable or growing. So net income going up. Free cash flow choppy. So let's not use this, but we've seen the use of free cash flow. Factories, international markets. Now we understand the strategy of the business, the growth levers of the business. Internationals, more markets, more factories in Thailand or other countries. And we have seen some decent return on invested capital, 15%, 10 to 15%. Okay, so I think the other thing to look is the valuation. That's loading. That's too long.
Do you see a risk of having half of the revenue coming from one product?
No. You see, there is a brand in the US called WD-40. I don't know if
yes,
right. Yeah, that's
WD-40. Yeah,
that's exactly one brand, one product, and that's it. They sell this thing. I don't know how to explain it in English, but this is this thing.
Oh, right.
Okay.
This is construction.
It's used for many things.
Yeah.
And they literally say one thing. So that's 100% of their business is this. And we've seen with the Monster beverage, we've seen the analysis, but most of the revenue from Monster is coming from drinks.
One
the same
product.
yeah, one product. They
Yeah.
sell some other stuff, but the big thing is the Monster energy drink. So this is not a risk at all. If you have a good brand, if you go to a Target, to a Home Depot, you want WD-40.
That's right.
You want it. You
Yeah.
don't want a substitute from
Or
China
knockoff.
or Poland. You don't care at all. You want this one. It's working. It's well. It's quite. I don't know the price. I don't know if it's cheap or not, but you want this one. You will tell me, guys, if this is cheap or not. But I don't know.
I have some. It's very handy.
Is this a glue or?
WD-40, you don't know what that is. It's just a spray can. So if you have like a squeaky door hinge, you give it a little spray of WD-40 and it lubricates. It's a lubricant.
Yes. Okay.
It's like duct tape.
Oh,
It's a
yeah.
good
When something
testimony.
is not working, well, you do this.
That's right. Yeah.
So yeah, I would
Turn it off
not
and on
worry.
and try WD-40.
I don't worry much if 50% of the revenue is coming from this. No, and especially since it's their best brand, they said that it was growing 16% per year. Decent growth, great growth, great margins, and I suppose that they make a lot of this. If you want to go deeper into the segments, now we've seen the fundamentals for the whole business, the whole company. But if you wanted to go deeper, if you want to know, for example, the profitability of the 3 segments, the margins for one segment, I suppose in the annual report you have this. But because it's Belgium reporting, I don't know. In the US, you will find this. You just find reporting and you will find the different margins, gross margins, EBIT margins for the 3 segments. Because it's a Belgium company, I don't know if they are forced to do it. I don't know if this is mandatory. No, I'm looking for a table for revenue. No. Seems like no, not necessarily. Okay, let's put revenue per segments. Revenue, they don't disclose it. Okay, revenue per segment, we have it. Yes, but I want the profitability. Revenue. No. I want the big table. No, in the US, most businesses in the US, you will find it. Revenue, no. Okay, I guess we'll just continue. Financial information, maybe here. If I zoom in here, profitability 2023. Do they expand? No, that's global. That's not segment per segment. Okay, anyway. No. Okay, good to know. That's some bad Belgium accounting. That's good to know. In Nordics countries, Sweden, Norway, everything is detailed. That's great. You have everything, all the reporting, all the details in goodwill, intangibles. They just put everything for you. So the annual reports for Norway, Swedish companies, this is great. For Belgium, apparently not. I don't know many Belgium companies, so I'm not aware of this. Okay, let's go to the valuation. We have our great DCF tool from Stock Unlock, and the metric which is standard is the free cash flow. But we've done the work. We know that free cash flow is volatile. We know that free cash flow is not the best metric to forecast the business, the future of the business. So let's just look at the net income earnings. We know that that's sustainable. That's the best indication of doing our work. And the DCF model, this works totally fine, regardless of the metric you use. Free cash flow, EBIT, net income, EBITDA, if you want to play with some numbers. If you don't like, if you would like to use EBITDA, I never use it, but everything works fine. I would advise to use free cash flow per default, like the standard method of doing a DCF is with free cash flow. But if that's choppy, use net income. And if that's again choppy, I will not even look at DCF, but you could use operating income in that case. I will not recommend to use book value. EBIT and operating income is literally the same thing. I would not advise to look at this and not look at this. So free cash flow or net income. Okay. What? Okay, let's try it anyway. What do you guys think the growth of earnings will be in the next 5 years based on everything we've seen? I'm asking you the question.
10%. I think that would be safe.
Yeah.
Yes. Yeah. I mean, we don't take much risk. The business has grown 10, 12% per year, 14% per year for the past 20 years. It's very likely that they won't do 30%, but they won't do 6. So yeah, 10, 11, that could be very decent. Let's go for 10. For the buybacks, I don't know for you,
Don't
but
mind buybacks.
I have not seen in their future plan, in their investor presentation, I've not seen any plans of buybacks. I've not seen any plan of big acquisitions, big share issuance. They don't mention it. For the growth, they mention international, brand, more products. So, zero.
Dividends. They
So,
mentioned
yeah,
dividends.
dividends, but in terms of shares outstanding, nothing. Here we have
Yeah.
dividend growth. This is very minor. This is not significant at all. Just put the average number. It's 14. Let's go for 14. It's by how much you think the dividend will grow in the next 5 years. And it doesn't make any difference to your valuation. I think there is a problem over there with the DCF because they don't give me a fair value. What is happening? Yep, that's strange. Most recent override, Kager. What is this black line? Stock price? Oh, the stock price is bugged at because that's a Belgium company and Stock Unlock doesn't like international stocks. Okay, let's see. You see the black line, the price that is not moving. Actually, if the stock is listed in the New York Stock Exchange, they should have a ticker symbol. So I should be able to replace this. That's strange. Lotus Bakeries Belgium ticker, because apparently there is a bug with the American ticker symbol. Apparently the price is blocked. So let's look at the Belgium ticker symbol. I don't know. That's the first time I encounter this. This LOTB.
LOTBY.
BR.
Lotus Bakeries Euronext Brussels. We have it. We have it. LOTB.BR. Let's see if the stock price moves. Yep. That's perfect.
That's good.
Okay, we have net income. You have 5 years. We expect the earnings to go 10% per year. Yeah, that makes sense. And we have 0% buyback, 0% share issuance. The stock price, the total amount of stocks will not move. The dividends, I was telling you, the dividend growth rate will not have a major importance. For example, the fair value, we have 6,600. If we put 0, we have a slight difference of 50. If we have 100%, we have it. Okay, that's significant. But okay, if we go from 50 to 25, not significant at all, to 35, okay, it must be 50 to start to move the thing. So it won't make any difference. You can stay with the 5-year average, especially since we saw that in the investor presentation that the dividend was up and to the right, smooth ride, up and to the right, an increase year over year of dividends. We can expect at 99% that this will continue. They will continue to pay dividends. So, okay, let's put 50%. The PE ratio. What will the PE ratio be in 5 years? I don't think it will be.
So the P ratio is. It's a P ratio they ask for. It's a price ratio, though.
Yes.
Or it's the same.
That's the same. That's the price ratio compared to the metric you've put here. So if you put free cash flow, you will have the price to free cash flow. If you put earnings, that's the price earnings ratio. Average price net income, for example, it will mess up everything. You ready? If I put free cash flow, Okay, that will get average price to free cash flow is 81. And if I put back earnings, it changes. Average price to earnings over the past 5 years, 40. Okay, let's go back to bam,
Okay.
10, 10, 10. Okay, so on average, the PE ratio has been 40. We've seen on Stock Unlock that it was 25, 30,
yeah.
and in 2020 it shot up from 25 to 50 or 60.
Closer to 25.
Yeah,
25
that
would
will
be
be
nice.
absolutely I mean, we could go and see the average PE ratio over the past 20 years. I don't know if that's helpful, but we already know the chart of the price to free cash flow. It was like 10 in 2005, and then 15, 15, 20, 25, and then 50. But if we had to have an average over 20 years, PE ratio, boom, 20 years, let's go 20 years. The average is here, 25. You're completely right. Yeah, that's a rough way of doing the, the valuation, but you want to be rough when you do evaluation. It's completely useless to be precise in numbers because we not know. There are a lot of businesses that continue to grow their PE over time. And
did we maybe I missed this, but the reason why the PE ratio shot up to where it is now, why that happened?
Not necessarily. We can see it, but it's just the supply and demand of the stock market.
Okay.
I suppose what we talked about before about paying up for quality businesses, it seems like other people saw what we just saw. So other people realized, guys, it's a premium business, safe business. So more and more people realize that it's a great business, and more people are willing to pay up. And if we are willing to pay up a P of 25, 30, some people can pay a P of 40, 50, apparently 60. So it depends. Every person has a different risk tolerance, but that's the way I prefer to not go over 30. But some people go and invest for a long time. You see the same thing for Costco. Costco is a safe investment and is becoming more and more better company, better margins, better revenue. So people realize, okay, we have a P. That's for Costco. P of 25, P of 25, and then same thing in 2019, 2020, P of 35, 40, going back down to 35, and now it's at P of 50.
I see. So it's kind of based on what people are, what the stock is being bought, and people are just putting out that money for it. It drives up the PE ratio.
Yeah, especially for these retailers, especially for these big discretionary consumer goods businesses. It's about confidence that's specific to this industry. It's about confidence, stability of earnings, ability to forecast the 10 years of the business. For our Lotus Bakery, we can totally forecast what will happen in 10 years. Nothing big. Literally, the business will become more and more profitable, more revenue, more brands, more factories. It's very easy. We don't need a crystal ball for this. We already know what will happen in 10 years. So the stock market doesn't like uncertainty, and the stock market rewards certainty. So because our business is very certain, we know at 99% sure that what will happen in 5 years or in 10 years, you pay up for this. And same thing for Costco. We all know what Costco will look like in 5 years. They will continue to sell cheap stuff with big volume, and they will enter China and do the same thing. And everybody realizes this, and that's it. It's just that paying a P of 40, 50, that's expensive.
Yeah.
So if we go back to the P ratio, and let's estimate we have a P of 30, we have fair value that is half what is the current stock price. If we say, okay, P ratio will go back to 25, okay, that's it. We have finished our DCF. We have, if I sum up, earnings for the next 5 years that will go up 10%. Safe assumption. No buybacks. Dividend will grow 15%, but not significant at all. And after the 5 years, the PE we estimate will go back to the average of 25 because of the hype will decrease, because you have several ways of decreasing your PE ratio. Either the stock collapses, we have a crash, but this will maybe not the case for our solid, resilient business, or earnings catch up. Earnings are improved. So in our formula of price divided by earnings, if the earnings increase a lot, the price to earnings will decrease, and we will get a more reasonable P ratio. So given these assumptions, our stock is overvalued by a lot. So how to understand this? We have our stock price in black. That's the real stock price. And this is our assumptions of constant P ratio of 25. So if the stock had a constant P ratio in 2018, 19, 20, 25, 25, P ratio 25, 25. If the P ratio did not shot up to 50 or 60, it would have been this green line, this and this and this. So if we have our estimate, the business is very overvalued. That's the current stock price. That means in 5 years, the future stock price, given all our estimates, given all what we see as forecast, we think that the future stock price will be 6K. The dividends will be this. Okay, again, dividends are insignificant. We saw before on GuruFocus that the dividend yield was 0.5% here. So literally not a big deal. And fair value right now, as if we would buy the stock right now, based on our assumptions, the fair value of the business right now is 4.2K, which is 50% below the current stock price. So we can say this business right now, as we are speaking in July 2024, is 50% overvalued. The price is twice as too high, too expensive. And if we want to invest right now, given our assumptions, if we invest right now, even if it's overpriced, we would expect to lose 7% of our investments every year for the next 5 years.
Wow. Okay.
Yeah. So not a good deal. We've seen the business, but every business has a price. This is not a good price. And if we think, okay, it's not 10%, it's 15%, will it change? Okay, what do we have? We have overvaluation still, but the expected annual growth of our investment, we will not lose 7%, we will lose 3%. That's still bad.
Yeah.
Still bad. And if we put 25%, that's impossible for them to do 25%. We will generate some earnings, and the business is only 20% overvalued. Oh, that's a mess. And what would be the good price for the current? Actually, you can estimate what is the market pricing in the stock right now. The goal is to have this fair value at 0. Okay, so you play with the number 31, no, 31.5. Okay, we have 0. So given the market right now, the fair value is at 0. So
this is the reverse cash flow, right?
Exactly. That's it's called the reversed DCF, the reversed discounted cash flow model. You want to get the fair value at 0, playing with the numbers. So right now, the market estimates that earnings will grow 30% per year for the next 5 years. Given a P ratio of 25, you can say, wow, 31%. Who thinks the business will grow 30%? I agree with you. Maybe people estimate a growth of 20%, and you can play with the numbers, and they think the P ratio will not be 25, but will be sustained at 40. The goal, again, to have a fair value. That's it. Here we are. Okay. If, again, we saw a fair value at 0% having earnings growth of 30%, but another way of finding a fair value at 0% is with a earnings growth at 20%, which is more reasonable. I mean, they've been growing at 14%, so that's a stretch, yes. That's a stretch, a bit of a stretch, yes. But if they continue to have a P ratio of 40, they can be fairly valued. And again, right now we have a P ratio of 60. So if you think the P ratio would stay at, let's say, 50, so really high, what would be your estimation of future growth? That's a bit less, I suppose. So let's say 14. That's it.
We had the price.
Okay. So right now, given the growth in earnings, has been 14% for the past 20 years. So the business is growing 14% per year. If we think the business will continue to grow 14% per year for the next 5 years, right now the markets estimates that they deserve a P ratio of 50. That's expensive. But that's what the market is pressing in right now. So P/F ratio, a lot of optimism. So right now there is a lot of optimism towards this stock, and P ratio can change. You've seen it. It went from 35 back to 25. So there is some chance that the stock price will decrease or the earnings will grow, and we will have a P ratio that will decrease over time from 60 to 40 to 35. It can happen, but nobody knows what the next move of the stock market will be. We can stay elevated with a P ratio of 50, 60 for 3 years, 4 years, 5 years. It doesn't mean anything. Nobody can predict if the P ratio will decrease to our 25 P ratio in 2 years. Nobody will predict it. But in a lot of scenario we've seen, the stock is overvalued. So now I think you have a decent overall view of the business and how you can play with the numbers.
Yes, amazing.
Thank you.
I'm just adding.
I learned so much today. Wow.
That's good. That's good. I hope it was not too boring because that's quite technical.
No, it puts a lot of makes sense to a lot of things. You have to do things in a certain order, and I definitely know that I do not do enough research, and so I know that I will need to be spending a lot more time. And on 2 companies in particular that I currently own, that's where I'm going to start.
Oh, absolutely.
Yeah.
You will follow the same template.
Yep.
But for the companies.
Yeah,
what was
absolutely.
what are the names of the companies?
Well Health Technology, so WELL.TO. That's one. I own some stocks in that, and the price actually is this past week has gone way up. So it's I'm making some money on it, but I again picked that based on a recommendation and had no idea what I was doing. And the other one is Equitable Bank in Canada. EQB, I think, is the ticker. And that one is also doing very well. Yeah. So Equitable Bank. It's a digital banking platform. I believe it's the only one in Canada right now. And they don't have any physical locations anywhere. It's all electronic. So yeah, those are the 2 I'm going to really dig into.
You will have some surprising things. I suppose that's profitable. That's a digital bank. Sounds like it's a profitable business to me, but maybe you will have some surprises.
Yeah, definitely. Yeah.
Well, if you have other questions for the template, I have some time, so you can ask any question you want based on the exercise we just did together.
I have one question. Oh, sorry, go ahead. Okay.
No, go ahead. You go ahead.
I just have one question about ROIC. We looked at that, and I am having a hard time sort of internalizing the meaning of ROIC. Like every time I look at it, I have to go back to the formula of how it's calculated. So is it, and the formula is quite complicated when I look at it in stock unlock. Is it like, okay, a business borrowed some money, has some assets, and how much return are they generated on it? Is that like in plain language what it means?
Yes.
Okay.
Yes.
And what's the difference between it and I think there was another one, ROCE or ROIC, ROI?
Return on capital employed. Yes.
Employed. Okay. So employed meaning they borrowed some money but they didn't use it?
I would say don't spend too much time looking at the differences between the 2.
Okay.
Most of the time they are very similar. If the return on invested capital is 15%, you will get a return on capital employed, ROCE, of roughly 15%. You will get maybe 17 or 13, but it's about 15%. The formula, that's funny because last summer I spent some weeks looking at the formula to calculate return on invested capital, ROIC, and there are different ways of calculating it. You can have. I have found 6 different ways of calculating it. So on Stock Unlock, you will find some formula, decent, yes, but the company will say otherwise. And on Seeking Alpha, you will find otherwise. But on average, you will play with some numbers. You will get 15, maybe 14, 16, 16.5. It doesn't really matter. It doesn't matter. That's 15. That's not 35. That's 15, 18. Voilà. It's just to have a rough sense of the, and that's exactly the same thing for return on invested capital. You can have several formulas, but that's overall 15. That's decent. You will see
After that one formula, I can ignore return on employed capital. I can just focus on invested capital.
Yeah, exactly.
Okay.
Return capital employed would be more short-term, given more investments, short-term fluctuations. But at the end of the day, I would just focus on the return on invested capital.
Okay, and the free cash flow was choppy. That to you is not a red flag. Like it's not a problem. Only because you were able to see that they were able to make proper investments into PP&E, right? Like they're investing in like future growth, and therefore you think, it's okay that they don't have free cash flow.
Yeah, we start with the first principles. We see choppiness in cash flow, fluctuations. Okay, so we ask the question, we have some great revenue growth and free cash flow going up. So understand why. Sometimes in annual reports, you will not see why. Literally, you will not understand why. That's a red flag. Why do we have this big investment? Now we had some things to say about free cash flow generation. They said, okay, investments, and we understood facilities. After this, can you trust management? When they say they invest in facilities, can you really trust when they say it? Yes, because they've been doing it for 20 years. And there is some proof of what they're saying. They have 3 segments that tell you the same thing. They are growing international markets. That's plain, that's clear. They have shown you the geographical breakdown. So that's true. The earnings. I'm sure if you check the international revenue, country by country, in the next 10 years, they have all gone up. So that's a proof that, yes, the investments is true. When they say they invest in international factories, that's true. So we have seen this, they are not lying. Also, yes, we checked that if they have invested in factories, we want to see in the balance sheet, property, plant and equipment that increased by the same amount. So yeah, okay, they have not lied. You can trust them. So the choppiness in free cash flow, yes, is good, but I would prefer to not see choppiness actually. I would prefer to invest in a business that doesn't need to invest in new factories, that doesn't need these costs go. I want to invest in a business that is so good that they don't have any investments to make. They are in a strong position, top of the top. And some businesses are like this. The free cash flow is going up and to the right. That's the best kind of, that's my favorite businesses. But the choppiness right now, that's okay. I understand why.
Got it.
So
Yeah, makes sense. Because if they have to make these kind of investments, every one of these carries some risk, and therefore, if you compare it to another business that doesn't have to make this, then there's a little bit less uncertainty. Okay, that's
yes.
making sense.
There are
I have another question, but I'll leave it to other people first.
Are you guys familiar with TPL, the company TPL? It's quite small.
Heard of it, yeah.
It's
a railway company, right?
It's they own land in Texas. That's literally the best business I have ever seen.
Oh yeah, what's the name of it?
TPL. It's called Texas Pacific Land.
Texas, yeah.
Literally best business on earth. I don't know why everybody doesn't own it. Let's see. You see the return on invested capital that is extremely, extremely high. Oh, that's a bug here. My computer is dying. Return on invested capital of more than 100%. So, and you see EPS growth or free cash flow growth, which is enormous. Literally one of the best growth I've seen. Up and to the right. CAGR of 20% of EPS, earnings per share, for 20 years. That's unbelievable. And free cash
Yeah.
flow, same thing. Free cash flow, we have this 20%. That's unbelievable. You have the strongest margins you could dream of gross margins. Gross margin of 100%. 100%. That is some accounting change. But yeah, 96, 97, 95. So that's unbelievable.
When you're looking at two companies, and let's say you see them both as potential purchases, how do you, and let's say you only have one room to buy another company, like how do you compare them? How do you say, okay, this is a better opportunity than another? I think you've hinted at that a little bit when we were talking about, let's say, one that has shopping free cash flow, one that doesn't, so that kind of thing. But what else do you look at when comparing two opportunities?
I mean, if these are good deals, I prefer to buy them both. If
Yeah.
I know if you don't find many opportunities, you find two good stocks that are trading cheap, buy them both. That's very simple. Companies
maybe
are
ask
always
another
different.
way. Sorry, go ahead, Christophe.
Companies are always different, so you will always find differences. If these are two companies in the same industry, like for example, you want to invest in Lotus Bakeries and another snack company, you will find which one has the better margins, which one has the better future, the growth prospects. You want to see the capital allocation. Did they mess up in the past? You want to see the future capital allocation. For example, for Lotus Bakeries, we've seen international, so more markets, more volume, and more efficiency, more factories. Simple. For the other competitor, maybe it's we are going AI. I don't know. Maybe we're doing some other stuff.
Yeah.
We plan to do a big acquisition next year of our competitor that we will use some debt to buy a competitor. That's some risk. Red flag. That's some risk. We don't know. They will have more debt. That could be risky to buy to do an acquisition. So a lot of uncertainty. Will the acquisition be good? Not good? Efficient? Not efficient? So you compare the growth prospects, the capital allocation. You compare the track record. If you want to buy a company, we know that the Lotus Bakeries has grown 10, 14% for the next 20 years. You compare it, pure numbers comparison to your other investment. If the other investment has grown 8, 9%, you can say Lotus Bakeries is better. So all these things, you compare the ratios, you compare and the pressures, the risks, because if these two companies are in the same industry, they will have the same risk. And for companies that are not in the same industry, for example, you want to invest in Lotus Bakeries and you want to invest in Adobe, the software to do Photoshop. That's a different game. You can't compare the margins. That's something different. You have to compare.
Mhm. Yeah.
That's a different industry. Most of it, you can't compare the return on invested capital. You can't compare the growth rate because they are different. So I would say estimate what is a good risk reward. For example, for Adobe, you say it's a software business and the growth rate will be higher in the future because of software, AI, so literally a lot of tailwind. They will grow by more than 14%, more growth. So on paper, it's a better business, better growth opportunities. What is the PE ratio? What is the valuation? Because if you have Lotus Bakeries with a PE of 60 and Adobe with a PE of 25, it is very easy to make. You compare the risk and the reward, the quality of the business, the fundamentals, growth rate, capital allocation, to the price, the PE ratio, price to free cash flow. So it's a mental game. It's not a formula. It's literally when you will see company, you will see if this is a good buy, a good or not. So it's not a hedge, it's a arbitrage, it's a comparison between if you like the company or not, good fundamentals, growth prospects, and the price. So these two factors can determine if you prefer an investment or not.
Makes sense. Thank you.
Thank you, Christophe, for the example and for the analysis. It's good to see more analysis, and now I started to understand what is a good investment and what is not a good investment, and that's That's the base point. I know when it's too expensive or not, and that's cool.
That's good. That's great. Yeah, you will not understand now why people buy Bitcoin, because they can't do this analysis. On Bitcoin, there is no revenue, no net income, no margin, so no cash, no debt.
No, it's a bet. It's a bet on another project.
That's the advantage of investing with productive businesses. That's Warren Buffett who says it. Like, you can verify the earnings, the net income, the margins over 20 years. You can literally verify if this was a good business or not.
Sure.
For Bitcoin, you don't know. I don't know. Nobody knows.
It's just a bet.
Yeah.
Well, I'm
thank
going.
you, guys.
Yes, thank you very
have
much.
to go, me.
I'm going to buy some of those biscuits today.
That's very good. That's very good.
Yeah,
Well, I think
for sure.
that's it for today. Thank you for coming to this call. And I'll see you
you.
tomorrow with a special guest, Daniel Gladish, that will present his investment strategy, same time as usual. So I see you tomorrow, and thank you for coming today.
Amazing.
Thank you very much.
Thank you.
Have a good
Have
day,
a good
everyone.
evening. Bye.
Bye-bye.
Bye-bye.
Bye.